Hey everyone, and welcome to The Explainer. So glad you're here with us. You know, if you're a focused learner trying to build up your wealth, I bet you've spent literally countless hours staring at funds, trying to figure out the absolute perfect way to optimize your portfolio without totally wrecking it in the process, right? Well, today we're going to dive deep into the data and see why stripping away all that complexity might actually be your secret weapon to unlocking far better returns. $83,000. Let that sink in for a second. Imagine building this beautiful portfolio, carefully trying to play it safe by stacking more and more dividend funds just to protect your money, only to find out that very strategy actually cost you a fortune. We're looking at a real-world case here where an investor's potential $470,000 portfolio was completely dragged down to just $387,000. That is an $83,000 mistake, folks, and it happens simply from picking the wrong additions. Okay, let's dive into this. There is this huge myth in modern investing that stacking more ETFs automatically equals better diversification. I mean, it kind of feels right, doesn't it? More baskets, safer eggs. But in reality, throwing a bunch of funds together just creates this massive, hidden, tangled mess. You aren't actually diversifying at all. You're just hoarding the exact same stocks in different wrappers and paying extra fees to do it. It is quietly, slowly destroying your long-term compounding. To fix this, we've got to start at Section 1, the foundation, and a simple two-fund portfolio that actually works. Now, a lot of you are probably already doing this, and if so, high five, you're doing it right. Think of this as the classic, super reliable baseline strategy. You've got VTI, which is the total U.S. stock market, acting as your powerful growth engine. Then you pair it up with BND, the total U.S. bond market, serving as your nice, cozy stability layer. This power combo is undeniably fantastic. It keeps fees super low, gives you incredibly broad diversification, has historically proven long-term returns, and honestly, best of all, it keeps things beautifully simple with zero complexity. But this brings us to a really important question, doesn't it? If this setup is so incredibly perfect, why do we ever touch it? Why do we constantly feel this itch to mess around with a perfectly good two-fund portfolio? Well, the truth is, there are some hidden gaps in that two-fund strategy. First off, the dividend income is pretty darn low, which leaves a lot of investors really hungry for yield. Second, VTI is heavily concentrated in U.S. tech, which frankly leaves you dangerously exposed to the wild volatility of just a single sector. And third, there's basically zero global exposure. These three gaps right here are exactly why investors start hunting for a third ETF to try and fix their portfolio. Which brings us directly to Section 2, the costly mistake and the trap of overstacking dividend ETFs. This is the exact trap so many DIY investors fall into. You spot those gaps we just talked about, and suddenly you're throwing a whole barrage of popular dividend ETFs like SCHD, VYM, VIG, and DGRO into the mix. Maybe you even toss in a few covered call ETFs or overlapping international funds just for good measure. But guys, it creates a really dangerous illusion of safety. You log into your brokerage account, you see 10 different ticker symbols, and you genuinely think you're insulated from risk. But here is the stark, brutal reality of what more actually gets you. You're getting hit with higher management fees across the board. And worse, you suffer from massive hidden stock overlap. So when the market takes a nosedive, all your supposedly diverse funds plummet right together because guess what? They hold the exact same companies. You get absolutely no real diversification benefit. And in lots of cases, your tax efficiency gets vastly worse. The absolutely crucial takeaway here is that more funds do not equal a better portfolio. So how do we actually fix those gaps without completely ruining our portfolio? Let's jump to Section 3, the solution, the ultimate third ETF. After testing 12 major dividend and income ETFs against yield, growth, taxes, and risk, one consistently dominated. The winner is SCHD. Now, this isn't just another random ticker symbol to arbitrarily toss into your account. No way. This is the all-in-one strategic dividend upgrade. It's really the single multi-tool your portfolio actually needs to plug all those gaps we talked about earlier. Now, what's really interesting about this slide is these 5 undeniable pillars of SCHD's dominance. First up, it offers strong yield without sacrificing your growth. You're looking at a solid 3.5 to 4% yield, with dividend growth buzzing along near 8 to 9% annually. Your income is actually growing every single year. Second is its real compounding power. That reinvestment totally accelerates your wealth building. Third is a massive tax efficiency advantage. It mostly generates what the IRS calls qualified dividends, which is really just a fancy way of saying it gets taxed at a much lower rate, keeping way more of your own money right in your pocket. Fourth is portfolio balance, which we're going to hit on in just a second. And fifth, it's highly efficient. It boasts a super low expense ratio and institutional grade liquidity. Let's zoom in on that compounding power for a sec. 12%. Historically, SCHD hasn't just been some slow-moving, boring income play. No, it has actually delivered annualized total returns in the 12% plus range over long periods. That is the kind of engine that doesn't just pay your bills today, it is actively, aggressively building your future wealth. And here's how this beautifully solves our problem from earlier. Remember that super heavy US tech concentration in our foundation? Well, SCHD brings in a phenomenal balance. It adds really robust exposure to financials, healthcare, consumer staples, industrials, and energy. Honestly, this is SCHD's hidden superpower. It perfectly offsets that heavy tech lean of VTI, finally giving you actual genuine diversification. Now, I know exactly what you're thinking. What about all the other famous funds? Well, let's do a quick teardown in Section 4 to see why other popular ETFs lose this battle. Let's walk through these rejected runners-up. VIG and DGRO pitch dividend growth, but their fatal flaw? They're practically clones of VTI. It's just totally redundant. Then you've got VYM, offering broad high yield, but honestly, the dividend growth there is noticeably weaker. And what about those trendy covered call funds like JPI? Sure, you get a high yield up front, but your upside growth is permanently capped. That means you miss out on all the big bull runs, plus you're going to pay brutal taxes on that income. Finally, international dividend ETFs like VYMI pitch global diversification, but their performance is highly cyclical and super volatile. You see, each of these solves exactly one isolated problem, but they all bring a fatal flaw that just drags down your whole foundation. SCHD is the one that solves multiple problems at once. Let's bring this all together in Section 5, the philosophy, the real lesson that changes everything. We really need to refocus on the true objective of portfolio design here. The goal is absolutely not to just hoard more ETFs, or to blindly chase the highest possible yield regardless of the risk, or to pile on more complexity. The actual goal? One strategic addition, far better overall balance, and relentless, highly efficient long-term compounding. Look, most portfolios do not fail because they are missing pieces. They fail because they are overbuilt. Now, for those of you who want to take action right this second and start putting this streamlined philosophy to work, the great news is you don't need thousands of dollars to begin. The source material points out you can actually start investing in US stocks, even heavy hitters like Apple or Nvidia, with just $1 single in under 10 minutes using GoTrade. You can just head over to heygotrade.com and use the code 386990 to get yourself started even faster. I want to leave you today with this incredibly powerful rule to live by. In investing, simplicity often beats complexity, and consistency beats everything. The absolute biggest portfolio upgrade isn't adding 5 more funds to your account. It's choosing the single right strategic addition and sticking with it for years. So I'll leave you with this question to chew on tonight. If the market drops 20% tomorrow, do you actually know what your 15 different ETFs hold? Or are you just going to lose money 15 different times on the exact same tech stocks? Think about it. It might just be time to simplify. Keep learning, and I'll catch you on the next explainer.